Welcome back to All About Economics. You know that feeling when a $20 bill just does not go as far as it used to? That is not in your head. It is one of the biggest forces in economics, inflation, the slow erosion of what your money can buy. In the last episode, we saw where money comes from. Today, we ask what happens when there is too much of it, why prices rise, what it costs you. And then we uncover one of the most famous and controversial relationships in all of economics, the link between inflation and jobs, captured by the Phillips Curve. By the end, you will understand not just why prices climb, but why fighting inflation and fighting unemployment can pull a government in opposite directions. Let us put on our detective hats. Section 1. What inflation is. Inflation is a sustained, general rise in the overall level of prices. Notice each word. Sustained means it is an ongoing process, not a one-time jump. General means the whole basket of goods and services, not just one item like oil. And level of prices means we are tracking the purchasing power of money itself. When inflation is positive, every unit of money buys a little less than it did before. The everyday way to feel it is simple. If your income stays the same while prices rise, you have quietly become poorer, even though the number on your paycheck never changed. That silent erosion is what makes inflation such a powerful and political force. Section 2. The prime suspect. So what makes prices rise across the board? Our prime suspect is the money supply, and the key piece of evidence is the famous money equation, which links the quantity of money to the total value of spending in the economy. The core idea is intuitive. If the amount of money in circulation grows much faster than the amount of goods and services the economy produces, then you have more and more money chasing the same limited pile of goods. The result is that the price of those goods gets bid up. This is the classic explanation: too much money chasing too few goods. It is why episodes of very high inflation, from hyperinflations to wartime booms, are almost always tied to rapid growth in the money supply. Think of Weimar Germany in the 1920s or Zimbabwe in the 2000s. Where the printing presses ran wild and prices could double in a matter of days. The pattern is always the same. When money floods in far faster than goods, the value of each unit collapses. Section 3. The accomplices. The money supply is the prime suspect, but it has accomplices, and economists sort them into two families. The first is demand pull inflation. When total demand in the economy runs ahead of what it can produce, perhaps because of a spending boom or aggressive stimulus, buyers compete for limited goods and prices are pulled upward. The second is cost push inflation. When the cost of producing things rises, a spike in oil prices, a jump in wages, a snarled supply chain, firms pass those higher costs on as higher prices. In the real world, the two often feed each other, and once people simply expect prices to keep rising, those expectations become self-fulfilling, as workers demand higher wages and firms raise prices in advance. Section 4. The damage. Let us tally the cost to your wallet, because inflation is not harmless even if wages eventually catch up. Moderate, stable inflation is manageable, but high or unpredictable inflation does real damage. It erodes the value of savings held in cash, punishing savers and anyone on a fixed income. It blurs the price signals that businesses rely on to plan and invest. It arbitrarily transfers wealth from lenders to borrowers, since loans get repaid in money that is worth less. And at the extreme, in a hyperinflation, money can stop working as money at all, and an economy collapses toward barter. This is exactly why nearly every central bank is charged with keeping inflation low and stable, typically around a 2% target. Section 5. The Phillips Curve. Now to the controversial twist. Decades ago, economists noticed a striking pattern in the data, an inverse relationship between inflation and unemployment. Think of it as a seesaw. When unemployment goes down, inflation tends to go up. And when you push inflation down, unemployment tends to rise. That seesaw is the Phillips Curve, and for a generation it shaped economic policy. It seemed to offer governments a menu, a choice. You could aim for very low unemployment, but you would have to accept higher inflation as the price. Or you could keep prices stable, but only by tolerating more people out of work. The dream of low inflation and low unemployment at the same time looked, on this curve, impossible. Section 6. Why the seesaw? But why should jobs and inflation move in opposite directions? Follow the chain reaction, and it starts with one decision: a government opening its wallet to spend, say on new highways. That spending raises demand. To meet the new demand, firms ramp up production and hire more workers, so unemployment falls. But as the economy heats up and the pool of available workers shrinks, firms have to compete for labor by offering higher wages, and they pass those higher wages on as higher prices. So the very stimulus that created jobs also pushed prices up. That is the engine behind the Phillips curve. In the short run, demand drives both more employment and more inflation at the same time, two sides of one heating economy. Section 7. The Policymaker's Dilemma. This is the trade-off that keeps policymakers up at night. Every government wants a booming economy with plenty of jobs, but a booming economy tends to come with rising prices. Push for full employment with aggressive stimulus, and you risk inflation. Slam the brakes to crush inflation with high interest rates, and you risk throwing people out of work. The Phillips curve frames this as a genuine dilemma, a short-run tug-of-war between two goals a society cares about deeply. Much of practical macroeconomic policy, the constant adjusting of interest rates and budgets, is really an attempt to navigate this seesaw, leaning against whichever side has swung too far. Section 8. When the seesaw breaks. But here is the catch that reshaped modern economics. The Phillips curve trade-off is reliable only in the short run. In the long run, it can break down completely. The reason is expectations. If people come to expect, say, 4% inflation every year, they build that into wages and prices automatically, and the economy can end up with high inflation and high unemployment at the same time, the stagflation we met in the classical episode. The painful experience of the 1970s taught economists exactly this, that you cannot permanently buy lower unemployment with higher inflation. The seesaw is real, but it is a short-run device, and trusting it for too long can lead a country into trouble, a mystery we explore in the next episode. Conclusion. We have followed the money and solved the case. Inflation is a sustained, general rise in prices, driven above all by money growing faster than output, with demand pull and cost push forces as accomplices, and it quietly taxes savers and distorts the economy. The Phillips curve then revealed a short-run seesaw between inflation and unemployment, the engine being a heating economy that creates jobs and price pressure together. But that trade-off is only short-run, because once expectations adjust, it can vanish. Keep both ideas in hand, the causes of inflation and the seesaw with jobs, because together they sit at the center of every interest rate decision a central bank makes. If this cracked the case for you, please subscribe to All About Economics and share it. Next, the strange mystery of inflation that went missing. See you there.